Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, if we take a look at the 67, if we are thinking that the euro currency has probably seen its move, let's take a look at the 67 puts. Look at the spread between the bid and the ask, 74.81. We're talking 6 cents for an at-the-money put option. A 6-cent spread, that's pretty tight. Let me explain that to you. That's a pretty tight spread. If you think there's more room that the dollar's going to rally further from here, then you'd want to look at calls. You're going to look at the at-the-money. Notice that we also have a 6-cent spread on the calls. Now, I don't know what the protocol is for ISE, but since I don't work for that exchange, I'm going to tell you what the protocol is for me as a trader, and my responsibility is to give you, the attending audience, a decent education in this time that we have together. And that is, I'm going to compare the FXE, which is an exchange-traded fund, and that's what's been more popular with people, the currency shares euro currency trust, all right? Notice that up here, I want you to look at this one word here, these 3 letters here. And I'm going to change my color, so hold on a second. All right, well, what I'm trying to get you to see is where my pen is. And it says hard to borrow. Not only is it hard to borrow, but it's a little tough to trade. And the reason I say it's tough to trade because the bid and asks are not as tight, number one. We're at 149.5, right? So if you think that the dollar has rallied too much right now and the euro currency's fallen for right now too much, and we'll see a little pop to the upside, you'd probably look at a 149 call. Notice that we got a 25-cent spread on an in-the-money option. And out-of-the-money option, it's 15 cents. So, I mean, at the money with the ISE, you had a little bit better of a game going on with your bid and asks. And I'd have to say that this was a little tough as a trader. Back at the last week of July going into the even July 30th, I was in the 155s and the 152s strike prices. And then I just kind of rolled down. And for the record, I am flat this market, so I'm not talking up a position. And I'm just giving you, as a trader, a one-to-one experience story. And if you're not familiar with it, I think if you can just learn to look at a better vehicle, it's great to be in the market. And as a trader, the worst thing, the thing that just irks me the most is to call a market, have an order in there, be in the trade, be in the right side of the trade, and with an options, not get paid what I should or start getting jerked around because it's a thinly traded vehicle. And I think that with ISE, you got a little bit more bang for your buck. So if you're looking at euro currencies going forward, check out the ISE's euro index rather than looking at the exchange traded fund, the FXE, especially as an options play. So I think you'll find a little bit more bang for your buck, tighter spreads, and I'm just saying that just from my own personal story. I will definitely go and have hopefully some time at the end of this presentation for questions. What I'd like to do is kind of give you some trading tips and techniques, not only looking at seasonalities, and if you're not familiar with seasonalities, I think that was obviously very important to use. As we have more and more traders in the world, as we have more and more techniques introduced, people tend to get away from the basics, number one. And number two, I've seen more and more new technical tools being called or created or renamed, Stoke RSI, CCI has been reinvented, there's all different types of nuances in the market. But, folks, push comes to shove, there's really 4 main ingredients that we all need to pay attention to, and it's the open, the high, the low, and the close. And out of those 4 main ingredients, every form of technical analysis and tool all relies on the close as it relates to those past or prior points of interest, I call them. open, high, low, and close. That's right. The close is the most important. Every form of technical analysis is derived by using the close. Even final volume at the end of the day is determined by the close of business. And so I think it's important that whatever form of analysis that you use, understand what time frame of the year you're in and what does the seasonal aspect have to do with the kind of like the undertow current of the market. Okay, if you're buying dips in a seasonally bearish time period, you'll probably not have as good of a time in the marketplace. And so that may be one of the things that can help you with understanding how to trade with the underlying trend of the market. Stick with the seasonalities first off. The next aspect that I think that we need help in is something that can help us with market turns or trend reversals, your entries, your exits, your risk management, and improving your risk-reward parameters, or what we call the profit and loss targets. One of the things I can tell you, and I'll tell you what I've told my own son, two things that I think that I discovered a long time ago, and I mean back in the early 80s. When I first started trading, my biggest bang was, and when I say biggest bang, is the market that I made the most money in, believe it or not, was trading 30-year Treasury bonds back when Ronald Reagan was president, of course. In 1986, I discovered this amazing vehicle to get more bang for my money and with less risk, and I was able to sleep at night, and it was called options. One of the very first commodities that they introduced options on was the 30-year Treasury bond. So there's a little bit of history for you. Interest rates were going from about 11% down, and so there's an inverse relationship. When interest rates go down, bond prices go up. So anyway, many of you may have heard of, or read about me. I mean, Stock and Commodity Magazine had a big feature article on me, I think, last year. Traders Monthly Magazine had an article, and asked me about, some past trades that I had done. And I got news for you. One of the things that I think it was very important that in the story that I shared with my son, I'm sharing with you now, is this. I noticed that when a market would rally, all right, if the calls didn't move and the call options started to depreciate a bit, something was funny. Inversely, when the market was going up and yet put options did not go down in value, in fact, put options would go up in value, something was askew. So I think it's very important to understand the relationship of the market and options. And so for me, I had a really good knack for following options and looking at the relationship of the options. And now there's so many different software platforms, people looking at trading all the Greeks. You got Theta, Rho, Vega. We can go on and spend a whole series on options and how option pricing with the Greeks in theory works. But bottom line is this: keeping things simple works best for me. And I can say this, that in a seasonal time period, and if I have some decent triggers and setups, then I'm going to put some money on the table. I have predefined risk. I'm a directional trader, and I do that with options. I know that, I want to see what the potential of the market could get to. So I need to have some idea of looking at an old chart point of interest. Where can the market get to in a prescribed period of time? Now, let me reiterate and summarize what we've gone through so far. We talked about seasonalities. We talked about that in October the market makes a low. Over the last 10-year history, the average seasonal low is in October. So let's use that as our guide for the rest of the presentation, so to speak, and moving forward. If I know that October there's a potential low in the market, do I want to buy puts at the end of October for a December expiration? Probably not. If I know that we may see an average yearly in the last 10 years bottom in October, maybe I want to employ a different strategy. Maybe I want to do a credit put spread where I sell a close to the money put and I buy a further out of the money put for protection. It's a limited risk and it's a limited reward. But if the market kind of stabilizes, it's a high probability setup, or a high probability trade,
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.